Welcome to Bloomberg Markets. I'm Shonali Basak. Let's take a look at where markets are trading because, of course, after a record high in the S&P 500, we are lower today, of course, by 0.2% on that S&P 500, but really holding that 5,700 line. We are looking at a decline of 0.3% in the NASDAQ 100. The two-year yield holding a little steadier, only about a move of about 1 basis point, really flat on the day to 357, the 10-year at 372. This is where we look like where we're generally ending a week of a historic Federal Reserve rate cut. Some midday movers on the equity side. We're going to bring in Bloomberg Markets correspondent Abigail Doolittle for that.
Yeah, we have some idiosyncratic movers here, Shonali, having little to do with the Fed. Starting off with the shares of Nike, they are popping sharply higher, up 6.4%. This is the company is bringing in veteran Elliott Hill to replace John Donahue as the company's CEO and president. This will be effective October 14th. Wall Street, the analysts, very positive on this. The stock right now having the best day since September of last year. At the highs, shares had been up about 9%. At that point, the best day since December of 2022. I never know how to interpret that when a stock is rallying when one CEO is out, but it clearly seems as though investors really like the idea that this Elliott Hill, who had been with the company before on the product and merchandising side, he's coming back. Let's turn to a stock that's not faring quite as well, and this, of course, is FedEx. Shares plunging down 13.7%. This after they cut the outlook for the full year view. It appears that consumers are continuing to trend toward lower cost packages. Plus, the CEO is talking overall about a challenging quarter. It sounds as though there are some headwinds there having less to do with consumers going for that cheaper package and maybe for the economy. And when you have this in a week when the Fed has cut rates by 50 basis points, you have to wonder what's going on with the economy. Stay tuned, because we also have that bifurcated consumer, which goes for some products but not others. And then it is Triple Witching Day. Probably a piece of the reason that we've had some volatility with stocks down pretty significantly not so long ago, now down just a little bit. What we're looking at here is volatility for lots of different asset classes. In blue and yellow here, we have bond and currency volatility. You can see that that's a bit higher, and that should be the case as the foundational asset classes. And there is the VIX, Shonali. It's closer to a 16 handle, more in complacent territory. But it is interesting to note there's a series of higher lows there, pointing to the possibility at some point, Shonali, that there could be a move higher for the VIX. But on this Triple Witching Day, it seems as though it's more about intraday volatility and higher volume.
Abigail, I appreciate the look under the hood. For more on how historically have responded to rate cuts historically, we're going to bring in Bloomberg reporter covering equities, Alexandra Semanova. And I've got to say, this morning, I opened my Bloomberg terminal. I took a look at the stories, and you kind of called it. You said that the hefty Fed cut isn't at all clear for soaring equities, and lo and behold, we are off records today. What are people saying out there?
Exactly, Shonali. So the Fed has been teasing markets with interest rate cuts for 10 months now, and they finally got it this week. And there's no question that easing generally bodes well for risk appetite. We saw that yesterday, of course, with the S&P 500 hitting its 39th closing record, and all 11 sectors in the index up across the board. However, today's price action is really a reflection that the path forward won't necessarily be smooth sailing. If you look at history, front-loading cuts specifically hasn't generally fared well for equities. The last two times that the Fed began an easing cycle with a 50 basis point cut in January 2001 and September 2007, stocks fell over the next 12 months. So that could be fodder for the bears as they assess how the economy is doing. However, a very important caveat is that the economy is doing well, and the Fed is cutting into a period of strength. Profits are accelerating. So this is not really a reactionary cut to signs of a potential recession. And in the past, equities have significantly outperformed when the Fed cut against steady economic conditions versus cutting during a recession. So at this point, the bottom line is that the initial 50 basis points aren't really saying much. It's about the path forward and the pace with which they continue.
And that's where we have so much uncertainty. Alex, we thank you so very much for your time. That is, of course, Alexandra Semanova of Bloomberg News. Now, turning to the broader economy, we are joined by Kristina Hooper. She leads a team of macro strategists in North America and, of course, is the chief global market strategist at Invesco. We could talk about the bond market pricing because it's still quite extreme heading into next year. But let's talk about the equity reaction off the heels of these cuts, because there seems to be a lot of confusion or at least disagreement on whether 50 basis points means the economy is slowing faster than meets the eye. What do you think?
So, Shanali, I think you're absolutely right in that there's an awful lot of confusion right now, and markets seem to be alternating between excitement around a 50 basis point supersized cut and, of course, trepidation that there could be a recession in the offing, that the Fed knows something that markets don't know yet. I'm of the opinion that it is the former, that we are not going to see a recession, that we're going to see a brief, shallow slowdown, and that we will see a reacceleration perhaps by the end of this year, early next year. That will be triggered by or helped along by the rate cuts, but also improvement in real wages. That should lift all consumers, even though I understand that, of course, lower income households are under significant pressure right now. But there's always the risk. I mean, we can't ignore that there is a recession risk. Monetary policy has been restrictive for 14 months now, very restrictive. So I think that it's right to hedge that. That's why I think we've seen significant rise in gold prices. But at the same time, I do believe we're likely to see equities perform well, especially cyclicals and small caps, because they'll be discounting what is likely to be an economic reacceleration.
Well, the cyclical and small caps, I'm glad you brought them up, because if things go south, those are the areas where we would see the most pain as well. To the extent that you would put money towards those trades, how much conviction do you have in them with the risk that still remains out there in a soft or harder landing?
So I have a significant amount of conviction because I think the economy is in good shape. Yes, clearly the labor market is weakening, but I believe the Fed when they say this was a preemptive rate cut. And so that means to me, this is an environment in which rate cuts should really benefit the economy. And if we go back to 95, 96, that was the last time the Fed was able to tighten without causing a recession. Once the Fed started easing in the 6 months out from their value outperformed growth, I mean, both performed well. Now, small caps modestly underperformed large caps during that period, but I attributed it to the fact that the easing cycle was so shallow. It was only 75 basis points. We've gotten 50. We're looking out on perhaps 200 basis points more in fairly short order. So I think this sets us up for an environment where we could very well see a very significant economic reacceleration that will benefit small caps and cyclicals more.
So to the end that we are seeing that rotation continue on into cyclicals, into small and mid cap stocks, or even places just outside of the Magnificent Seven. We have seen before that Fed rate cut that S&P equal weighted index just reach historic heights. So how much more does that go? Do you think that the same trade that existed before that rate cut still is true today, that those kind of mega cap tech names could be a little less favored at this juncture than those other parts of the market?
I think so. I don't think that we're going to see any kind of significant drop in the mega cap tech names, but I think this is the time for small caps and cyclicals to shine. Valuations are attractive, and they really do have the wind at their backs. Now, again, the caveat is that there are long and variable lags in monetary policy. So we do, again, have to worry about recession risks. And that's why I think we'll see very significant volatility around every data point that relates to the health of the U.S. economy, particularly the labor market. So we just have to be prepared for that. But I do believe we'll see cyclical and small cap outperformance. They have legs.
How do you feel about this kind of bonds versus stocks equation at this point in time? For investors who are putting that marginal dollar to work at this juncture, do you look more to the fixed income or the equity market?
I would look more to equities, but I would not exclude fixed income. I think it's important to be well diversified, particularly so now as we see the start of a rate cut cycle. So I think there's a lot of opportunity in fixed income. Again, if we go back to the playbook from 95, 96, we saw bonds perform well once the Fed started cutting rates, particularly high yield. And I do think we're going to see a similar scenario this time.
Kristina, we thank you so very much. That is Kristina Huber, Chief Market Global Strategist at Invesco. And coming up, we're going to turn back to some breaking headlines that came out earlier this hour. The FTC suing 3 prominent drug benefit managers, alleging a scheme that elevated insulin prices. We're going to talk to a representative from the Federal Trade Commission next. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Basak. It's time now for the stock of the hour, and we're looking at three companies this hour: CVS, United Health, and Cigna, because there was news breaking this hour of an FTC lawsuit against the drug sellers, alleging that they engaged in illegal drug rebate schemes that drove up the price of insulin. In particular, you take a look there: Cigna down now 0.1%, United Health down 0.3%, almost 0.4%, and CVS Health down more than 1.6%. We're now going to bring in the FTC's Office of Public Affairs Director, Douglas Farrar. And you think about just the way the FTC has handled this and the response you might see from the companies as well. Can you bring us behind a little bit about any communication you've had with CVS, Cigna, and United Health in particular here?
Thank you so much for having me on the show. So the FTC conducted an investigation into the three big PBMs that control over 80% of the prescriptions filled in this country. And what we discovered is that their rebate scheme drove prices up for insulin, so much so that over the last few decades, the price of insulin has risen over 1,200%. And so the FTC investigated these practices and today filed a lawsuit alleging that the rebate scheme is an illegal business practice that harms consumers, especially patients. And we know 1 in 4 Americans with diabetes have trouble paying for these medications right now.
To that end, when you saw the price of the increase of these medications, how did you draw the line? And what was it exactly that got them there at the end of the day? And what does it say, frankly, Douglas, about the other drugs being sold?
So the rebate scheme is complicated and opaque, but simply put, the PBMs make a lot of money on the rebates. And what that means is that it pushes the price, the sticker price of the manufacturer's drugs higher and higher because they can extract higher and higher rebates. In fact, it just turns competition right on its head. I mean, there's a basic tenet of competition that it should lower prices, but in this case, it actually was the reverse. And these price increases can have a huge impact on patients, especially people with high deductibles and premiums who may be paying the cost of the medication on the sticker price. And you pointed out correctly that this behavior isn't exclusive to insulin. Although the lawsuit is focused on insulin, this type of allegedly illegal scheme applies to a lot of different drug categories as well.
Well, bring us a little more behind what you're looking at here, because if you had taken a look at insulin prices here, and certainly a very important medication for many, many Americans, how far can your kind of scope go here as you take a look at pharmacy benefit managers?
Well, you're right. Our lawsuit is focused on insulin, and we'll seek to make the case in court that this rebate scheme is one that does have anti-competitive effects. But this scheme could be applied to other categories of drugs. And so if we're able to win the lawsuit, we may suggest or go for an injunctive remedy that could be applied across a wider category of drugs.
We're talking so much about the PBMs alone here. Are there implications for this lawsuit that go beyond the broader PBM industry into the broader industry of healthcare?
Well, you're right that the lawsuit's focused on the PBMs, but the staff at the Bureau of Competition, our colleagues in the Federal Trade Commission, saw fit to also issue a statement that ensured that the manufacturers also are on notice that their role in this marketplace is of concern, in fact, deeply troubling, according to the statement from staff. And so certainly the PBMs play an important role with their rebate scheme in driving up the cost of insulin and other drugs, but they're not alone, according to FTC staff.
It's interesting because when we think about the FTC and the moves that have been made this year, there have been a lot of questions about not only pricing here and what pricing has looked like for Americans across different industries, but also in terms of mergers and acquisitions. I'm really curious, Douglas, if you saw mergers and acquisitions of the healthcare industry really playing a role in the way that PBMs are able to extract these prices in your analysis.
Yeah, that's a really good question, and it's true that there's been a huge amount of consolidation in the PBM and this part of the pharmaceutical supply chain. PBMs are vertically integrated, and together they own things like CVS and pharmacies. They also create the lists of drugs that are available to insurance companies and payers and patients. And we saw a really big increase that started in 2012 and has accelerated and created a market that does have a host of concerning problems with respect to competition that the FTC has looked at.
Do you expect the pharmacies to continue to respond to this? Because this is at the heart of what they do here. These rebate programs have become quite massive. Do you have a sense, you talked a little bit about the price of insulin and how much it rose in the wake of what you're looking at, but what about the rebates themselves? How much money has this returned to the companies?
You're right that this is very core to their business models, and at this point, these very consolidated companies get something close to half of their revenue from these rebate models. The problem is that they're really not providing much value to patients or to payers or insurers with the rebates. One effect we contend is that they're basically just forcing the price of drugs up through a kind of reverse polarizing competition from being a good force in the market to a bad one. So on behalf of patients in particular, we filed this lawsuit to try to ensure that there's more competitive balance in this marketplace.
It's interesting because there are certain things when you think about regulatory actions or lawsuits being filed against large corporations, there has been a lot of politicization. But when it comes to the PBM practices and drug pricing, this has had a little bit more bipartisan affection here, if you will. There have been both sides. I mean, what type of support are you getting from lawmakers?
Well, certainly when we issued our interim PBM report a few months ago, we got a lot of bipartisan support on the Hill. I think at the end of the day, Americans are living not just in the pharmaceutical industry, but in an economy in which consolidation is so rampant, and they feel the effects of that every day, be it on customer service calls that take hours or you never speak to an agent, on high prices at the grocery store and elsewhere. And so we've actually felt a lot of bipartisan support, not just from Congress, but from the American people in the work that we've done. And certainly with healthcare, it's central to some life and death questions, and so very near and dear to people's hearts.
We talked a little bit about the integration implications, but what about the pharmacy and retail side of the equation here? How might that be impacted?
So independent pharmacies in particular have struggled with the consolidation in the PBM industry, and a lot of them have been forced to close, which leaves sort of pharmacy deserts in various different communities where they're not served by the big PBMs, pharmacy outlets. This lawsuit's very focused on the price of drugs and what patients are paying, and less so on pharmacies themselves. But certainly we want to make sure that we have a healthy pharmacy supply chain, and pharmacies are a part of that, and we want to make sure patients are paying reasonable prices for drugs.
Douglas, we thank you for joining us on the heels of this news. That is FTC Office of Public Affairs Director Douglas Farrar. And coming up, we're going to talk about an all-new Wall Street week. It's going to debut tonight on Bloomberg, and this week we heard from U.S. Treasury Secretary and Wall Street Week contributor Larry Summers. He gave his take on the Fed's big rate cut.
The risks of actually going as far with monetary policy as the Fed seems to think that it will are pretty significant in terms of having an increase in inflation.
This is Bloomberg Markets, and I'm Shonali Basak, and Wall Street Week is relaunching tonight on Bloomberg. It's the destination for investors seeking to think more deeply about business, the economy, and financial markets. Host David Westin speaks with some of the best minds in their respective industries, and he joins us now for a sneak peek. And David, we think about what we have ahead. Can you tell us about some of the luminaries that you're speaking to?
Yeah, as you know, we talk about the restaurant business. One of the businesses we talk about is restaurant business. We got Danny Meyer, whom you know, quite a famous one, as well as Daniel Boulud. But we also have Melba Wilson, who has a small restaurant up in Harlem called Melba's, so a family shop as well. But some of these are really big businesses.
How are they feeling affected by the local economies right now? I'm glad you brought up Melba's, for example. It's a staple.
Well, it is a staple, actually, exactly, up in Harlem. And she started, this is a little fun fact, it's in the piece. She started when her neighborhood was really in decline, and she decided to do something about it by starting a restaurant. She'd been a waitress in a lot of different places. She went home and discovered she'd been saving up money from tips for a number of years. She had $312,000 in cash under her mattress, and that's how she started her restaurant up in Harlem.
Incredible.
And now, as you say, it's a mainstay. But Danny Meyer thinks that, particularly since the pandemic, because the restaurants took an awful hard hit during the pandemic, since the pandemic, the restaurants that have come back are actually more vibrant, more interesting than ever in New York.
Now, let's take a look at one of the interviews that you had with the CEO of Dynex, shall we?
I think what we've seen in commercial real estate is some of the biggest name player. I'm going to take one like SL Green, for example, one of our partner, and they have those spectacular building like One Vanderbilt, One Madison. They're trying to get tenant in. They're trying to bring people back to work in the office. That's their whole business. They need to bring world-class amenities, and then they come to people like us and say, hey, what could we do here?
David, I love that interview.
Yeah, Dynex is Daniel Boulud's company, which is, as you know, a very large company. They've got restaurants all around the world, in Singapore and things like that, as well as New York. But this is, I hadn't thought of the restaurant business as basically a strategy for return to office, which is what they're doing down at One Vanderbilt.
It's funny, when I return to this office, I am appreciating the kind of renaissance of restaurants we are seeing in New York City.
Well, it's fascinating, isn't it, Shani? Because a lot went away. We lost a lot of restaurants, but now there are new restaurants coming in, and as I say, Danny Meyer thinks that they're some of the most interesting and creative we've had.
David, we thank you so much. Catch the relaunch of Wall Street Week tonight on Bloomberg. Don't miss it. It's at 6 p.m. New York time. I'm Shonali Basak. That does it for Bloomberg Markets. Keep an eye on these markets through the end of the day because, of course, we are off those records now, but still holding above that 5,700 line. Let's see if we stay there. This is Bloomberg.